I'm going to go over 5 different things you can do to help your portfolio in this kind of heightened volatility market right now. 5 things that you can do, and and hopefully that'll be able to kind of help you be able to weather the storm a little bit. But keep in mind, these your situation might be more dire, or it might be just perfect, and you don't have to do any of these things. But I'm going to give us 5 things to talk about.
Please subscribe to our channel. Happy trading. There's your rest.
All these 5 things before. Okay, so it's not some magical pill or some panacea I'm coming up with, right? So, but just trying to revisit it so it can be clear. If you have 100 shares of a company, okay, we talked about this in the past. You can collar off those shares. So, for example purposes, let's just say you have 100 shares in Apple or 200 shares. If you have lots of 100, then you can collar off those to kind of protect yourself to the downside. And so, for example, let's say it's 37 days. We went out to 37 days here. If we had 100 shares in Apple, we could sell a call if we haven't already against the shares, and we can buy a put. Right? So if you wanted to do something like this 160, you can buy this or sell this call and go and figure out how to buy a put for something lower than what this price is, right? So it's about 225. So you can buy something like this 140. So that would stop your losses once it hit the 140. If we have a really bad situation and Apple's falling a lot as well, then you won't have to worry about it anymore after 140 within the next 37 days. If you want to get more aggressive, because this is basically 4 points up, you can go and sell the 155. That's going to give you more capital, over $4, so you can actually go to this 145. So you can sell the 155 and buy the 145. That's obviously going to protect you more to the downside at this point, and then you can just let things play out and not have to worry about this with this is falling too much. We have that same kind of issue here. We have the same thing here in the Thinkorswim count, right? So we have this collar on Walmart, and it's barely down $1 to $2 a day. We have it also on Coca-Cola. That is down a little bit more because our collar is at 57.50 and it's trading a little higher than that, but that's also fine. So, but we can't lose any more below 57.50. But normally, if things start to go crazy, Coca-Cola would be a safe haven. Not worry about that falling. All the other kind of speculative stuff that's potentially might fall a lot. Okay? But not too bad so far in this account this morning. But this is the collar strategy. Once again, you if you have 100 shares, you sell a call, and then you buy a put that's less than the call. So this call is giving us about 440. So you buy a put that's less than that. That will protect you to the downside, and you will be able to rest a little bit better. Right? So that's one way. Another way is you can take profits, okay, on winning trades. If you have any winning trades, if we look into this account, you can see right now that we have a overall winning trade on this riot. We haven't adjusted this riot or anything like that. We could take profits if we wanted to free up some cash there. On this RTY, we've got an overall this P&L open column. That's showing up, but it's not really up because this been an adjustment. So we wouldn't have to take any profit. We can't take any profits there. Then all this other stuff, you can see that we can't take any profits as well. So that is not an option for us at this point in this demonstration account. But you might have that option. You might only have 10% profits, 15, 25% profits. You ring the register there, free up cash, take off some risk, and make sure you lock in that profit if things worsen. So you can reduce size that way, right? And do not put on any new trades, right? So that's number 3, reducing size. Do not put on any new trades because you're wanting to try to keep your account in that 30% range. You don't want to use more than 30% of your account. Normally, at the Dorian Way, we're talking about using no more than 40% of your account to initiate trades. Obviously, when we're doing something short term that's going to be off really quickly, 0 to 1 DTE, then you can use more of your cash. But you have to understand that you can't roll that out then and so forth. You can't turn that short-term trade into something long. But we're trying to be safe here, so you want to be trading as small as you can. I wouldn't add any new positions if your account is already being stressed. don't add any new positions. Use that capital to be able to defend this market if it continues to deteriorate. Okay, so another thing step forward that you can look for is that you can roll up calls to collect more premium, and you can also decide when you roll up those calls to buy put spreads to be able to double up on short delta, right? Because when you sell a call, or if you're rolling up calls closer to at the money, that's giving you short delta. Okay, so for what I mean by that is that if I go over to this RTY, and if we go here and this is the call at the 8 delta, and we decide if we're going to bring this up. Let's say we decide we're going to bring it up to 11 delta. So we do this. So we are getting in risk, and then this one's going to be the new one, and this is going to be the new one. So if we roll this up three contracts, we're going to collect another 247. If we roll that up, and we're going to make this a little bit less risky because we're collecting more premium, and that's offsetting the potential losses to this downside here. Okay? So and we're not touching this side yet. It's just the 27 deltas. It's still in the yellow zone. It's a higher yellow zone, but it's still in the yellow zone for us. We can also look to do stuff like that in some other accounts or underlinings. So this is the ES. This is something on the put side there. That's a 22 delta. That's the yellow zone. So that is fine for us right now. If we go to this call side, you can see we have nothing on the call side. So if we wanted to, we could sell something on the call side. Do something like you want to match the other side. So this other side was only 10 points wide. So we could do just 10 points here at this 10 delta. That's going to give us another, $50 or whatever the case may be in premium, right? That's another thing you can do. That's reducing your risk, because your max loss risk, because you're collecting more premium. If we go to this 16 days to expiration on this ES, you can see we have something that's in the green zone on this side, the 3610. So that's fine. Now on this call side here, we have something that's at a 0 delta. So this would make a lot of sense to roll this up, to buy this back here, and then move this up. And then if we move this up to something like, let's just say we decided we're going to go as high as the 8 delta in this example, and this is a 20-point wide spread. So we sell this 8 delta, buy this 4150 strike, and that's going to give us $85, right, of more premium. It's also going to increase our buying power a little there. So that's what we can do. Reduce max loss risk, get a little bit more short delta, because moving up those calls is giving you short delta. All right, so another thing we can do, you can go out for long dated positions. So this 37 days, we have 37 days. Look on this put side. This is the 24 delta. Once again, this is in the yellow zone. That is looks like a 20-point wide spread. So if we go over here on this call side, we only have a 10-point wide spread. So, and that's a 2 delta, which is in the green zone. Once again, we can roll this up, just showing you how you can do this. If we took this to a 10 delta, and I just say we decided to make it 20 points wide, it'd be something like this, and that would give us $108 more. So you guys notice that we've probably, if we roll up the RTY positions, we roll up these ES positions, we have collected over $500 in additional premium at this point, all short deltas that we are getting to be able to reduce the risk. And if we go here, this is the yellow zone as well. You just go through your positions. I'm kind of showing you a demonstration on how you can do that. This is another one that can be rolled up and collect some more capital, right? You can also decide to roll things out. I don't have anything in this account that we need to roll out at this point, but you can roll things out to a later expiration date, and that would reduce risk and give you a little bit more breathing room. The last thing I wanted to talk about is step 5 is that you can use the micro futures to kind of help yourself out. So for example purposes, so if I sold this micro future by clicking on the bid up here, this is going to require about $500 and just under $600 in buying power, as you can see right here. But this is going to give me short deltas. It's going to give me 5 short deltas. I'm going to be able to make $5 per point as the ES goes down. But if I wanted to kind of offset some of my losses, I just say I wanted to do this for 16 days, maybe things would clear up. So what I can do is go and decide to buy a call to offset this here, and it's probably going to be able to give me this for a credit in buying power. So yes, so I'm spending $200 right here, give or take, to be able to gain more buying power and get some short delta. Okay, because as this falls, we'll be able to make some money as this goes down. So this is how you can get into these pretty fast and be able to help yourself to the downside with these, and you can adjust this based on how you want it. So if you wanted to go all the way to something like a 50 delta, something like that, that's going to obviously give you a little bit, in this account, it's giving us a little bit more buying power, but that's going to require a little bit more capital to do. But if things continue to deteriorate downwards, you'll be able to hold on and be able to do something like this. So normally I try to put on, if I do something like this, I try to put on the option first, because the option is the thing that's usually going to be a little harder to put on, because you might have some slippage or something like that in the trade. So keep that in mind. So if I went and let's say I decided that I was going to go something like this and do that, and that's a 29 delta, and we put this at, let's say, the mid, sent that. So we got that, and then now if we sell this micro future, and then now we have the position on. All right, so now we have that micro future on, that's short deltas, that's hedging us a little bit to the downside. You can see here, right? So, but if the market jumps back up, which we think it could, not necessarily go green today, but a little oversold. But if it doesn't, then that's fine. You've actually helped yourself to the downside with this type of move. Okay, it's going to be jumping around. These numbers are correct at this point. It's still a lot of volatility. Only the market's been open for about 25 minutes, so still a lot of volatility across everything at this point. So once things settle down, we get a little bit more clarity, then that would be great for us. But we're falling fast or going up fast, so we'll see how this plays out. But that's how you can offset your risk, and everything that you do, you want to do in a way that's giving you short delta and increasing your buying power. You don't want to do something that's reducing your buying power.